Hi, everybody. My name is Amin Reina, and I'm an investment coach at Sage Investors. And I'm here to do a quick little mind map of one of my most recent investment decisions, which was to buy shares in Johnson and Johnson, ticker symbol JNJ. I've been one of my core, investing themes that I've wanted to have, type of exposure that I wanted to have in my portfolios has been to have some exposure to the healthcare sector. And when I looked at Johnson and Johnson, I thought this could potentially be one way to get a really good, meaningful exposure to the sector. Usually, every time I take a look at a company, I analyze a company, I analyze a stock. It's about asking questions, and to me, in the courses that I teach, I've basically come up. There's some basic core questions that I ask myself every time I'm evaluating a potential investment, and I'm just basically going to walk you through those questions and how I answer them as they pertain to Johnson and Johnson. So, first question I always ask is when I'm looking at a company is what do they do? What do they sell? What is their value proposition? And when you look at Johnson and Johnson, let's put that over there. Essentially, what they sell is they sell healthcare. They are essentially a healthcare company. They sell products and services that really run the cross section of the whole healthcare industry. We're talking things like drugs, pharmaceuticals, medical devices. And then you have all the consumer sides, consumer products, products for baby, health cares, oils, lotions, creams, in that side of it. And so they cover a really diverse cross-section of different healthcare products. Some of their drugs are and it's not just that they're in those sectors. They are big players in each of these particular sectors. Like, for example, in the drug sector, they have one particular drug called Remicade. They have about 90% of the U.S. market. They just dominate the market. They have another one called Stelara. Another big big player in another very popular drug and a very well in demand drug. So when I looked at Johnson and Johnson, you can kind of almost consider them to be they're a conglomerate in a sense, but essentially they're almost like a pseudo ETF in the sense if you wanted to get exposure to the healthcare sector, just buying Johnson and Johnson would give you that exposure. So Johnson and Johnson essentially one of the dominant best of breed healthcare companies out there right now, and they've been around forever. Next question I always ask then is, okay, that's great. We kind of get a sense of what they are. Who do they compete with? Is there any competition? Does the company face any competitive pressures? Is it a competitive industry that they're working in? So in terms of the healthcare sector, there's there are some serious players. On the pharma side, you have companies like Pfizer, Bristol Myers in the in the device sector. Medtronic is one of the dominant players in the industry. Then you look at the consumer healthcare side of it. You're talking to companies like Procter and Gamble, Colgate, Palmolive, Kimberly-Clark. So there's quite a diverse nature of companies out there in the healthcare sector. So there's a lot of players, and it's interesting that Johnson & Johnson is a major player in that side. In terms of customers, okay, great. So they sell healthcare products. Who buys their products? Who goes and buys Johnson & Johnson products? Well, essentially they have products out there that cater to essentially kids, like babies, like we're talking cradle to senior. There's something out there that they could offer almost any demographic out there in terms of healthcare products. The question, though, is when we look at potential customers and the types of customers, do they cater to customers who would come back to them and buy their products repeatedly? And the answer to me is obviously yes. Healthcare, health, and wellness. There's always going to be a need, and it's not so much a need; it's almost a necessity on that sense. So I think, especially increasing age in the population. So the answer is yes. There's definitely a consistent demand for their products, and that's kind of what we want to look for as investors. We want to buy companies that sell products that people are going to want to buy over and over and over again to generate more and more cash flow for the business, to make the business viable and ultimately make the business more valuable. So clearly, Johnson & Johnson is a dominant player in the sector. They sell products that people want, that are in demand, and so from this side of the equation, it all looks good. But then we got to get to the that's all nice and good. But at the end of the day, we're investors, and so that leads to the next question that I always ask is, do they make money? Is this a profitable business? This is a business that's creating value, creating tangible wealth for its shareholders. Now, when I look at when I try to answer this question, I usually come at it by looking at a couple of data points. And to me, one of my go-to data points is the whole concept of economic profit, which is taking a company's return on invested capital and subtracting the company's cost of capital. If it's a positive value, that means this company is generating positive economic profit. It's creating tangible wealth for its shareholders. So when you look at Johnson & Johnson, if you look at their return on invested capital over the last 3 years, it's ranged between 21 and 24%, which is really solid. And when you compare it to their cost of capital, it comes in about 9.2% roughly, about 9%, 10%. So clearly, from this perspective, this company is generating a lot more returns on capital greater than its cost of capital. It's creating positive economic profit, which is definitely what I want to see as an investor. And they've done a pretty good job of doing it quite consistently. I saw a number that said the company has gone 30 plus years of increased profit and growth. And if you look at their product line, 27 of their products or brands had sales of over $1 billion last year. 27 different product lines had generated sales over $1 billion last year. So this is a really solid company that has demonstrated ability to create wealth consistently over a long period of time. In fact, if you looked at their dividends, if you're all about dividends, they have increased their dividends, I think the last count, 55 straight years, which is pretty impressive. So clearly the company is making tangible wealth, is creating tangible wealth for its shareholders. Next thing that I'll want to take a look at in terms of numbers and financials is the strength of the company's balance sheet. What is their financial position? This is a company that's going to go out of business tomorrow. When I looked, now Johnson & Johnson is probably one of the few, there's only a handful of companies on the planet that have like almost a perfect credit rating, like a AAA credit rating. Johnson & Johnson is one of those companies. They have a AAA rating on its debt, which means no business or bank or financial company is going to have a problem giving Johnson & Johnson. They don't have a problem raising money, and it's because the management of the company has been extremely disciplined and is very disciplined in terms of how they allocate capital, how they determine which companies or which products to get into, how they diversify their portfolio of healthcare products. They've done an absolutely masterful job over the years of doing that. When you're digging into the financials, again, AAA credit rating, current ratio, if you look at their liquidity, which is current assets to current liabilities, is 1.4, which is over 1, which means it has more than enough liquidity to pay off its short-term obligations. Its debt equity level is at about 0.5, which is pretty reasonable. This is a company that generates a lot of cash flow. It's just a money printing machine. And when you look at their times interest payable, they have generate 26 times more income than they do interest costs on it. So from that perspective, again, this is a pretty clean, pretty solid company from a financial position. Their goodwill, they have a pretty high goodwill. That makes up almost 50% of their assets, which normally for me would be a concern. But given the nature of of healthcare. There's a lot of research and development. There's a lot of kind of growth that's a lot of time done by acquisition. So they go out and buy a lot of small businesses, small companies that have new emerging technologies or new emerging drug products. They will tend to, sometimes it's just easier to just go out and buy them than developing it in-house. So again, pretty dominant player in the healthcare industry, consistent economic profit, consistent wealth creation, pretty solid balance sheet. So far the story to me, for Johnson & Johnson's looking pretty good. Now, like any company, we need to also understand the risks, because what are the threats out there that could potentially take down a company like Johnson & Johnson? Well, the nature of the healthcare industry, there's lots of risks. One of the kind of risks that drug companies or healthcare companies have to deal with, or pharma companies have to deal with, is drug expiry. They could spend billions of dollars developing a product, but they only get kind of exclusivity to sell it for a limited amount of time. So drug expiry is a bit of a risk factor. And so there's always an importance on looking at having sort of a pipeline of products, of drugs that they could potentially roll out into the marketplace. And so the problem with that, which makes it risky, is there's a lot of regulatory hoops you got to jump through to get there. Then, of course, there's also the legal liability stuff. Somebody gets sick, somebody dies, something doesn't go right with their drugs. They can get sued, and that can create a lot of constraints on the business too. Another risk also is there's a sort of a switch. People want more natural ingredients, and a lot of times Johnson & Johnson's been criticized because a lot of their products are, have a more chemical component to it than incorporating natural extracts and herbs. But the company has, in the recent analyst meeting, has shared that they're actually they're going to be converting some of their more popular products to integrate more natural ingredients in them. So that's a potential challenge, and the company seems to be trying to respond to it. But it's something that could potentially maybe make people switch away from Johnson & Johnson and look at other possible alternatives. So that's all good, well and good. But at the end of the day, we're investors, and ultimately, when we're looking at stocks, we want to ultimately buy stocks that are cheap, that are that offer the potential for future value improvement. And so, the last question we always ask ourselves is the stock cheap? Is the stock trading at a discount relative to its intrinsic value? So there's a couple of ways you can kind of look at the valuation of a company, and that's compare Johnson & Johnson to other drug companies and other healthcare companies and see if the share price is cheaper or more expensive than other companies. So on a relative basis, it is cheap. On a relative basis, stock is trading at a multiple of 16.3, a forward price earnings multiple. And that's pretty lower compared to companies like Clorox, which is trading at 21. Colgate is trading at 21.7, and Procter & Gamble is trading at about 18 to 19. So when you look at it from that perspective, Johnson & Johnson definitely is cheaper than other similar healthcare companies that are out there. In terms of discounted cash flow analysis, looking at an intrinsic value, valuation models that I've seen out there have the stock valued at between 130 to 160. As I said, the time I started looking at the stock that really got me interested in looking at the stock was at the 125 level. The stock had been coming down up. It was at one point earlier in the year about 150. So it was down to 125. And so when I look at it, there's potentially, I think, at least a 20% upside. And then on top of it, getting about a 2.5% dividend yield. So when you factor all these, so when I looked at everything at the end, I looked at it, this is a company that's definitely a best-of-breed company, a dominant player in the healthcare sector. They are in a cross section of different kinds of businesses. They sell products that have a consistent demand over all different kinds of demographics. They're creating tangible wealth and have been doing it very consistently for a long period of time. Their balance sheet is pretty rock solid. Lots of cash flow getting generated, strong credit rating, strong ability to pay off its debts. And it has the management experience and competency to manage through a lot of the risks that are inherent in the healthcare sector. And ultimately, right now, when I looked at the valuation of the company, it seems to be cheaper. It seems to be cheap right now, and I think there's at least some upside and potential yield that can be gained from it. And so when I factored all of these elements together, it seemed to me that owning a company like Johnson & Johnson, which is a very diverse portfolio of healthcare products, is a probably more efficient way to do it than owning a bunch of specialized healthcare medical device companies. You kind of get everything, all that exposure through one stock. I can go out and buy an ETF and do it, but I felt because of the valuation, I thought maybe there's more upside and a potential to have a bigger gain on it. So when I put all these factors in, I came to that decision to buy. So that's my analysis of my quick mind map that led me to my decision to buy shares in Johnson & Johnson. If you want some more info in terms of how I go about this framework that I use to make investment decisions, you can check out my website, sageinvestors.ca. As I said, I teach courses on how to evaluate companies and stocks and how to make more successful investment decisions. You can check me out there on my website, sageinvestors.ca. Thanks for listening in. Thanks for watching. Take care. Bye.